All right, all right, all right. So welcome back. I hope you had a chance to grab some food. It's been an eventful program already, but now we sort of have what I think is really the highlight of it. We've had great presentations thus far, but this is something that I think is truly special. So we'll have Alexander Fleiss, the CEO of Rebellion Research, give a keynote address on nowcasting. And then he will introduce and moderate a panel with leaders in AI in finance about different use cases and generally sort of what new work is being done in machine learning in finance, data analytics in finance, and all of these sort of cutting edge methodologies that we've been hearing so much about already. So a bit about Alex. He's the CEO of Rebellion Research. He's a widely published author, a great teacher, my personal friend, and it's a pleasure to have him on the program. Please go ahead.
Thank you, Paul, so much for having me today. It's an absolute pleasure to be here. Like Paul said, education is my passion, research. Rebellion Research is both a think tank, primarily, but also an asset management firm. We have over 150 researchers, include generals, astronauts, mostly graduate PhD students. Our board includes directors of Cornell Financial Engineering, Berkeley Financial Engineering, Columbia Math, Yale FinTech, Treasury Secretary. And so, you know, I worked very hard over the last 20 years to build a firm that is focused on research and education. And the genesis of our firm was, without a doubt, machine learning. I could say, you know, my story begins in the mid-90s when I started as a programmer for video games. And I was born deaf and autistic. So, you know, 12 operations later, I was able to hear. I'd not learned how to speak English the way everyone else does. I had to actually learn it on my own. So I wasn't a coherent speaker until I was about 14 or 15 years old. So that was challenging. I had trouble really making friends. And so mathematics programming was a natural outlet where I could do stuff without having to interact with other human beings. And so I really loved that. And then at Amherst, I went to the National Math Championships. I got very close with the chair of the math department. And we did a project together where we got Amherst College to give us a lot of funding for K-means clustering algorithms to predict the S&P. And that was a really cool group we put together. A lot of, one guy actually went on to he's a partner of Bain now, Joseph Malikiel, really cool guy. Also, I think he was the COO of Jet.com. It was myself and Jeremy Newton, who's now he's the head of, I think he's head quant trading at BlackRock, great position. But before that, he was also Peter Thiel's head of AI trading. So we had this really fantastic group, and this was maybe 2003, 2004. And at the time, all we could do with K-means clustering was maybe 100 basis points over the S&P. And I don't know if anyone knows what K-means clustering is, but it's really useful. It's really valuable, but it's for framing a problem. So if you get a new data set and you're like, I don't know what to do with this data set, K-means clustering will start kind of, you know, putting it in perspective, giving you some ideas as to where to proceed. And by the way, I think machine learning in general is something that should come for the final 1/3 of the race. The first 2/3 of the race should be based on your theories and what you're trying to solve. So, for instance, before I finish my story, just while we're on this point, I did a research group at Cornell Financial Engineering last fall, and it was a lot of fun. I'm going to have all students on with Victoria Averbach, the director of the school, to discuss our findings because our findings were really interesting. We used natural language processing to show that quarterly reports have both positive and negative correlations with price return. But we got most of the way there before we even started applying the machine learning. So that's kind of, you know, machine learning is a great optimizer at the end of the day. You know, it's when you've got, you know, you can't just give it cosmic dust and expect it to find, you know, the root of string theory. You need to give it direction. And so that gets us back to my story now. And when I say you need to give it direction, you know, think Rain Man, think Dustin Hoffman. You know, Tom Cruise had to bring him to the casino, show him exactly how to play, show him exactly how to do it. He would never have gotten there on his own. And no machine learning system will. So what happened was, so I started Rebellion Research with the chair of the Amherst College Math Department and the Peter Thiel guy. But we realized immediately that we needed machine learning. And I was out of luck. I cannot develop machine learning systems back in 2002, 2003. It was above my pay grade. But I had a best friend at the time, Spencer Greenberg. If people want to check him out, Spencer has gone on to become a well-known cynic, skeptic, started his own venture capital firm. You know, and so as soon as Spencer could, you know, financially leave Rebellion and be a, you know, pure thinker, he did. You know, I of course was very attached to Rebellion, and I couldn't just, you know, leave when it was financially available. I wanted to keep directing the ship, and then I realized, since I am an educator at heart, I will turn Rebellion into an education institution. So that's why I stayed with it. But nevertheless, we went to Spencer, who was working at the time for the NSA, National Security Agency, developing machine learning for smart document search. And so the idea being that the NSA had millions of documents of foreign nationals in specific countries and specific cities. And in this specific city, you know, they might have all of the soccer league registries. And then they might have all of the apartment complex registries. And the idea being that if we had a known terrorist subject potential and another known terrorist subject potential, subject A and subject B, and they had an apartment, you know, they lived near some unknown, and maybe they also played soccer, you know, as Europeans call it football, with these unknowns, all of a sudden, this unknown unknown would become a known unknown. And so that's what Spencer was doing. And, you know, government work pays very little and it's very unrewarding. And so I said, hey, Spencer, actually, I phrased in the Rebellion Research was an economics company at first. I said, hey, we're trying, and that's what we are, at the root of what we are, and what, you know, we got on the cover of the Wall Street Journal in 2010 for calling the Greek debt crisis before anyone else did. And, you know, that's what we do best. We make these economic calls, you know, also make a lot of mistakes too. When you're right 62 to 60% of the time, you're wrong 38 to 40% of the time. So you're wrong a lot as well. But we've done a great job of calling these, you know, big kind of seismic events where it was kind of easy, if you will. For instance, before I go on, let's jump into Greece. Look back, 2009. Markets are going up hard. People are throwing money left and right. Mid 2009 was very much like now. People were very excited, green shoots everywhere, a lot of money being thrown at things. People finally started to get comfortable with the new President Obama. And so emerging market managers were desperately looking for the hot new country. And Greece used to be, you know, the poster child because it was an emerging market, but at the same time it's European, so it's relatable, they know it, you know, it's not too far off. Whereas like a Guyana, which is actually an amazing economic story right now. Guyana has more petrodollars per capita than all of OPEC. But nevertheless, you know, Greece, for instance, got a ton of economic investment capital in mid-09, despite the fact that the economy was sputtering. People were not paying their loans, retail sales were dropping, everything ugly was occurring. And so it was almost like kind of, duh, who wouldn't touch Greece? Greece has actually been the equity market that over 20 years we've had the highest win ratio on. So it's generally been an easier market to call. But going back to where Rebellion Research was in 2004, so I went to Spencer. And I said, hey, Spencer, you know, we built a K-means clustering system that's doing like 1.5 points over the S&P, you know, ton of turnover, and we all feel we need to use some machine learning. And you're the only person I know who, you know, because back in 2002, 2003, finding machine learning was hard. First of all, people thought it was a campy, silly. People used to think what I did for a living was, they didn't respect it. I mean, it was tough. I come from a very academic family. My great uncle was the chemistry chair of USC chemistry and was also a member of the Manhattan Project. Worked with Richard Feynman. Brilliant guy. My uncle actually nominated 4 times for a Nobel Prize for his work with ethanol and photosynthesis. So actually, my sister also, by the way, works for Harvard. My sister-in-law works for Harvard Business School as a teacher. So I really love education. It's a big part of my family. And so to work in a technology that people didn't take seriously, which back in 03, 04, people did not take machine learning seriously. You have to realize that the AI bubbles were the 60s and the 90s, and it had gone nowhere and done nothing. And people had just kind of said, oh, okay, whatever. But with the work we had done in finance at Amherst with my professor, it was clear that we needed a system that could adapt to data sets that were semi-unrelated. And so we just couldn't get there. And also, by the way, I'm skipping, I worked for Neuberger Berman partner Laura Sloat for 2.5 years. I built the first stock screener she ever had. Before Yahoo had a stock screener, I worked with her to build a stock screener back in the late 90s. So I very much watched kind of electronics take hold of Wall Street. The idea that you couldn't search for a stock on PE ratio, it's amazing. But nevertheless, we really, anyway, I did a project with Laura Sloat back in 2001 where we looked at economic cycles and large retailers. And the only way to accurately call large retailers consistently during times of economic malaise was to call the economic malaise, was to know we were in an economic down cycle. Otherwise, you're going to get left holding the bag because the PE ratios, the valuation factors that we hold so dearly become absolutely worthless when the economy goes south. And that's why we knew we needed a machine learning system, because you need to be able to move in one direction in one cycle, but then move in another direction in another cycle, which is very, very tough for a single or multivariable function. So Spencer actually had been working on a dating website, dating app. And Spencer's idea was, and by the way, if people want to go to YouTube, he's done a bunch of TED Talks on like love and emotion, and he specializes in that. And Spencer's insanely smart, really cool. And he's just a thinker. I don't know if people know Dan Ariely, but two of them are like good friends, and they do a lot of like stuff together. And Ben Goetzel is actually someone I became friends with through Spencer. I don't know if anyone's seen the show Silicon Valley, but the HBO show. But anyway, Ben built the robotics, the robot Pepper that addressed the British Parliament. Ben's like a very out there, benevolent AI guy. Anywho, reverting back to our story, Spencer's dating site was concerned with facial recognition, deep learning facial recognition using concurrent neural networks. Spencer's PhD advisor, Spencer got a PhD at Cornell, and when he got his PhD, his advisor was Jan LeCun, who went on to become a great. I'm sure everybody knows. If you don't know who Jan LeCun is, you should Google him. He's probably the godfather of deep learning, and I got very lucky in that one of his students and PhD advisees happened to be the guy I asked to build the machine learning for my economic research company. And so I got very lucky. In life, luck is a very, 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 very big part of anything. It's just the way it is. And luck can go on for a very long time, by the way, too. There's this Harvard Business School professor who used to have everyone in the class stand up and he'd say, everybody, flip, everybody had a penny, and he'd say, flip your penny, everybody with head sit down. And sooner or later, everybody would sit down, everybody would sit down, everybody would sit down, and there was one person left standing. And you go, okay, see him? That guy's Warren Buffett, because that's the amount of luck you need to make that many right calls. Now, some people say, oh, that's ridiculous, Buffett was just that good. But I believe at this point that there's a certain amount of meritocracy that gets you to become the Jim Simons, but you also need some luck. And by the way, one more point about luck is something that so Jim Simons I got friendly with because he hosts these math dinners at his apartment on 87th and 5th. And Spencer, my partner, used to go to the math dinners and brought me along once. And actually, a funny little tidbit, for the first 18 months of Renaissance's existence, their entire portfolio had a 300%, I mean, they had other positions, but gold alone made up 300% of Rentech's equity. Luckily, gold went up, inflation was insane, and yes, inflation was a lot, Reagan's spending was huge, and so that was a good call. But no matter how many economic factors you have behind any call can go wrong. You never know, things happen. Tsunamis, frauds, things happen. Every call has a very high fallibility ratio, every single one. And that's something that Simon says now and agrees with. But the point is that even James Simons, a man who has now become the king, in my opinion, of quants, started by being a little bit of a Sky Masterson and taking on significant risk early on because he started with like no capital. He was a SUNY professor and he couldn't access any capital. So he had to turn his like 200 grand into $1.8 million. And then once he had $1.8 million, he started getting some other real investors. But one of the negatives of fundraising is that you have to have capital to attract capital. I know it's like a chicken and egg situation, but that is unfortunately life in hedge fund fundraising, which is evidenced by why James Simons basically kind of bet the house on gold early on. His feeling was, hey, if I don't make enough to actually get people interested, what's the point anyway? Who cares? I'll just go back to teaching. And so he kind of had a, oh, I have no loss. I don't have anything to lose here. And by the way, Simons is one of the greatest math professors ever. Everybody loved him. Amazing teacher, very open. People go talk to him. Just a very, very, very open guy. Very, very anxious guy, sadly. He's a terrible chain smoker. But Mr. Simons is one of my heroes, one of my idols, without a doubt. So my dead hero is Richard Feynman, of course. Obsessed with Richard Feynman. I think he's absolutely just the greatest. And his work with the Challenger space shuttle explosion, if people don't know it, is one of the coolest scientific examples probably in the history of the planet. He proved to the planet how incompetent NASA was by taking a store-bought O-ring and showing that when you put this piece of rubber in cold water, immediately the elasticity changed. And so clearly, if you're dealing with a rocket launching, the issue is going to be many times that. And so, if you can't, Einstein said, if you can't explain something to a 6-year-old, then you don't know it yourself. And so between that and Richard Feynman, I kind of feel that way. And so it's taken me this long to finally get machine learning, but I've been able to. I have a 6-year-old daughter, and I have been able to explain it to her, which has been a lot of fun. And I think I'm getting her very interested in what I'm doing. But nevertheless, Spencer's dating site was using deep learning that he had, worked with Yamakun on to find people's preferences. And so the idea being that to enter his app, he would give you 500 facial images and you would rank them. And with 500 facial image rankings, he could pick out for you the ideal face for you. Very superficial site when you think about it. That all of matches are based on faces, but nevertheless, obviously there's very, 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 very high data that shows that initial facial reaction is a gigantic part of getting married. So, nevertheless, so we said, hey, why don't you keep that he never ended up starting that company, but nevertheless, keep that and let's use that deep learning to look at the economy. And so we ended up taking the deep learning facial recognition technology that Spencer had built for his dating site and adapting it to the global economy. And from 03 to 05, we were epic failures, and we were not doing a good job. It was the deep learning was losing 10, 20% a year, just could never make money. So that's when, and by the way, we built Rebellion Research in the opposite way of how I teach my students. So I run research at a number of schools, about maybe 8 or 9 now, I guess, including, as I mentioned, Berkeley, Columbia, Cornell, Fordham, and now actually also the Air Force and the Air Force Office of Scientific Research and Space Force. just offered Rebellion a research partnership actually this week. We're very excited about. We're going to be using computer vision on images of the stars to create maps for our Space Force. And so the idea being that we're going to have wars in space. We need to create maps to then create battle plans. And so, I couldn't, not serve my country. And it's obviously a very cool honor and a fun thing. Nothing to do with finance whatsoever, but, I'm very excited about it nevertheless. So reverting back to 04 to 06, we learned the hard way that when you're building a machine learning portfolio manager, you need to start with your data set, clean your data set. And by the way, Claudia Perlich, head of Two Sigma's data, friend of mine, maybe 15 plus years, we actually co-taught a Columbia class, data science, maybe 4 years ago. And Claudia says she spends 90% of her day at Two Sigma just cleaning, scrubbing data. Doesn't sound very glamorous. Well, it's not glamorous. And to be honest, most of the time I spent in R&D for Rebellion was not working on our machine learning. Well, we worked on it a ton, but it was actually on the data delivery itself. We realized that the data we were giving our system was dirty, very, very, very dirty. And to give you an idea, the Bloomberg 04 data, we felt that there were improprieties in as much as 88% of Bloomberg's data. Now think about the 737 MAX. I'm sure we all read, data gets a little faulty. Well, data got a lot of faulty there, but the plane crashed. Nevertheless, if we have faulty data, a portfolio manager is not going to work, and it didn't work. And so we realized, SHI blank, we can't build a system on dirty data. No one can. We can't fly a plane, driverless car. You can't buy and sell the market. You can't do it. Data cleaning is what you have to do as a quant. And so we were like, wow, we've got to imagine. First of all, so we had to, like the Doctor and Back to the Future. We had to think about this four-dimensionally. And so we stepped back and we said, hey, how do we clean all of this data? We can't. It's too much data. We can't do it. We're never going to be able to do it. It's 20 years of historical fun. The amount of data Rebellion looks at is mind-boggling. So the idea of cleaning it all, we were like, oh, God, we'd rather jump off cliffs. We couldn't do it. So we looked at the problem four-dimensionally, like that. Oh God, what is his name? That doctor from Back to the Future. Doesn't matter. But we decided, it was actually my decision. Let's build a parser to go onto the SEC.gov's website, read the SEC fundamental data we need, and boom, we don't have to deal with Bloomberg's dirty data anymore. We can keep Bloomberg's dirty data and use it to cross with our data, and when in doubt, always revert to our data. But yeah, that's how we worked our way around the problem. And so we spent, and by the way, that script took me 2 years to build. And it took me actually, the person who helped me the most was this TA I got from Columbia Engineering, became like a good buddy of mine. And he actually is a portfolio manager at Point 72, killer now. He's got one of the biggest houses in the Hamptons I've ever seen. But he spent a year and a half with me, after class at Columbia, just building this parser. And, we'd go on every night and we'd go through and we'd read this data, take it, download it, read it, take it, download it. Now you get it all HTML free, boom, nice and easy. Like, oh my God, is it available? It's like having to build a car from scratch and being able to just go to the Ford lot down the street. That's how it feels to see all this data available in HTML on a daily basis to just be read by any 12-year-old. So we spent nearly 2 years building this script that could go onto the SEC's website. And that's what we spend so much time doing. And then, so yeah, data cleaning and pure quality of data is everything, absolutely everything. But then once you have the clean data, what about garbage in, garbage out? And so what do I mean by that? That gets us to the Bangladeshi butter phenomenon. Does anybody know that here, Bangladeshi butter phenomenon? Or I guess it's Zoom lecture, so used to teaching, but the Bangladeshi butter phenomenon, very interesting. Like maybe 93, 94, the UN and its infinite wisdom decided to spend $40 million on economic research to decide what data pool had the greatest impact on the stock market. So essentially they wanted to know what data had the secret sauce. Now, 20 quant years later, we all know there is no data with the secret sauce, and nobody really knows. There's of course many pieces of data that can be correlated with movements in one direction or the other, but absolutely no secret sauce whatsoever. However, the UN did not know this in 1993-94, and they assembled this gigantic committee of professors, academics, researchers. And what they found was that from 1982 to 1992, the Bangladeshi butter futures market, either weekly or monthly, I can't remember, had a 97.97 beta correlation with the S&P's 90-day movements, which is just phenomenal. Or maybe it was S&P 30-day movements, but either way, phenomenal. To be right on the S&P's moves 97% of the time, you would very quickly become the richest man on the planet. So very interesting. But then how did this data unfold? From 1992 to 2002, I would then be asking the class, what do you guys think the beta was or what it became? And what it became was 0.03. And so it actually flipped, literally complete inversion, just by chance. That for 10 years, we had a 97% positive correlation with forward prediction on the S&P, would drop to a 3% forward prediction ratio. So, wow. Which then gets us to the Bangladeshi butter phenomenon in play, in reality. What am I talking about? LTCM, long-term capital management. Very scary. I actually had a class at Columbia Math 2-3 months ago. Maybe 3 or 4 out of the 54 kids there knew who LTCM was, what LTCM was. But LTCM was the largest hedge fund in the history of finance. But it was all borrowed. They had 12 billion of equity, which I guess in 1998, figure 6, 7. I mean, it's about 70 billion of equity today. So they're substantial. But they had another borrowed of 800 billion. So it was at 800 billion in assets, it was the largest hedge fund ever. And still, I don't think any hedge fund has gone up there in assets. So, but they had a model, 47-year model with consistent win ratio that had been developed by Larry Hillenbrand, Dick Leahy, and the famous John Merriweather from Liar's Poker. Liar's Poker is another book by Michael Lewis everybody should read. There's no excuse to not read Liar's Poker. And while we're on books, the other book everyone on the planet should read is Big Deal by the super brilliant Bruce Wasserstein, the multi-billionaire founder of Wasserstein Perella, who was the chairman of Lazard, First Boston. It's a 1,000-page kind of chronology of asset valuations through the lens of this brilliant banker over 50 years. I have never been so influenced by a book as I was by Big Deal. The book I'm in is Dark Pools by the Wall Street Journal reporter Scott Patterson. He covers the quant shops for the journal, and the last chapter 24 is on me. So, but that book is boring. The books I recommend are Michael Lewis's Liar's Poker and Big Deal by Bruce Wasserstein. The book about LTCM is When Genius Failed by Roger Lowenstein, but it's a rather boring book. There's a secondary book that was, I say secondary because it didn't get as much fame. I believe it was called Printing Money, which is also about LTCM. That book was terribly boring. I stopped that after about 25 pages. But what happened with long-term capital management was that these partners, who were all Salomon Brothers, they ran the junk bond trading desk at Salomon Brothers. And by the way, outside the bond trading desk, excuse me, not just junk. They did. John Merriweather ran all bonds at Salomon Brothers, but Merriweather was known for doubling down on trades, and his mill worked for 47.5 years. And so when you have the gigantic balance sheet of Salomon Brothers, you can withstand a trade for a while. Now, this is something that John Corzian found out, in 2005 with MF Global, when he took a $2 billion broker, made a gigantic bet, and once it started going south, oh, whoops, margin call done. Now at Salomon Brothers, Merriweather could withstand a bad trade because the firm had gigantic capital. He could go to John Goodfriend, the firm's chairman at the time, and say, Goodfriend, I need, another X amount of money to keep this trade going, and he could get it. But anyway, he took this model, he left a bunch of Salomon Brothers partners in 1993-94, and they started what then became the biggest hedge fund in the world, long-term capital management. And their 47-year model was really simplistic. Like painfully simplistic, actually, and was one of the inspirations for my starting Rebellion research, my desire for diversification. I believe in diversification. Rebellion's final global alpha asset product is 112 global stocks, median market cap of $40 billion. We don't even trade below $1 billion because there's just too much inherent risk. We just, confidence ratio is low. And so I'm a believer in the bell curve, where you've got ultimate positive, ultimate negative, and then up at the top you have the S&P 500. That return is the top of the bell curve. And so I want to be a little bit over to the right on the positive side, but really close to the S&P 500, or as some people call it, National League style baseball, bunts, walks, low risk stuff. And it's got imprinted on me with my work with LTCM back in the 90s. And this model, this 47-year model, was so simplistic that when LTCM careened into its death spiral that enacted the first Federal Reserve all banks on hand meeting where all the banks had to come in and bail them out. But that's another situation which we wrote about a Rebellion, where Lehman Brothers was the only major bank to not take part in the LTCM rescue. Hank Paulson at the time, Goldman's CEO, was very angry about that, very publicly angry about that. And so when he was secretary with the Treasury in 2008 under Bush, and he decided not to bail out Lehman, Dick Fold, and frankly I agree with Dick Fold, believed that it was retribution for having not bailed out LTCM. But that also brings us to karma. I believe in karma, and like a great white shark to breakfast, I hunt for karma all the time. That's why I spend so much of my time working with needy students, probably some more time working with my students than I do researching, building, developing, because my students come first. I have a lot of children out there, and often I have to become like a father figure to them because they don't have a father or whatnot. I'm one of the luckiest people in the world. Can be luckier. My mother was the first female to run a $1 billion hedge fund. I have a grandfather, and Larry Silverstein, who owns the World Trade Center. So, my father was a spinal surgeon, speechwriter for Walter Mondale. I came from the luckiest background possible. So I spend as much of my time as possible giving back, helping as many students as possible. The only time I can turn down a student is when I don't see passion or a desire to work hard. Because I'll take a student from, most of my students generally are these fantastic 3.9s, Northwestern and, and Princeton or whatnot. But if I get a student from not one of those schools who has a passion and a drive, I can never say no. I really do very much believe in Einstein's 99% perspiration, 1% inspiration. That's kind of who I am and what I am. But anyway, getting back to LTCM, when they imploded, they were short the entire US bank index, which, by the way, you couldn't even do back then. The ETF, the XLF didn't even exist. They had to go to Goldman Sachs and get like the 200 biggest banks put together as a basket that they went and shorted. And then they were long Argentinian government debt, and they were long the Russian ruble. And that trade so fantastically imploded in 1998, you couldn't believe it. Argentina went belly up. Oil fell, so Russia got hit. The ruble is basically just, I don't want to say a derivative of oil. It's basically like, Butch Cassidy and the Sundance ruble. If Butch Cassidy's oil, Sundance Kid is ruble. They're just like the same thing. Not really. That's not true. And but at times they can be. Obviously, at times they won't be. But at times they can be painfully correlated. Russia, I think it was 85, 90% of their government is the what do you call it? Petrodollars pays for 80 to 90% of their government expenditures. So this trade blew up in 98. LTCM owed all this money. Banks had to come bail them out. Lehman, didn't partake, and so they got hit 10 years later, many people believe. But I realized, wow, diversity. The only way to build a quant shop over time is diversity, but not just diversity, risk controls. I don't know if anyone remembers Amaranth, but it was a hedge fund in 2006, a $9 billion hedge fund. Brilliant, smart quant guys. And one quant trader had built a really good natural gas trading model. And I know the guy, he's a smart guy, he's a nice guy. And when you're a hedge fund guy, if they give you more capital, you're gonna take it because that's how you get paid. You get paid on a piece of your capital. And so at one point, this Amaranth trader, it was a $9 billion fund, and he had gotten up to like a notional value of like 12 billion bucks. And so obviously his model imploded and he imploded the fund, but that's, the risk, there's just, example of risk issues. And so, at Rebellion, we cap everything at like, 200 basis points, and it's got, and we cap new positions at generally 110 basis points. So something's got to double to get up to, and then we start having to sell it. And so I am a Scrooge when it comes to positioning. I hate overexposure so much because I am so painfully scarred from the LTCM debacle. And it so upset me. And then Bear Stearns later on so bothered me. Another just overexposure situation. Really just, very, very, very painful situations I lived through. But, and so Rebellion's deep learning had, we had to come up with a way to kind of spoon feed economic data to our deep learning system. And so what we came up with was something called the solar system. And it's silly and it's cute and it worked. And it's worked now for, well, we improvised system. I'll get to that later. But in 2006, to make, the deep learning, to give it an easier time, we realized, we're giving it too much data. It's too complicated. It doesn't know. We need to cheat more. We need to cheat more. We gotta help, we need to guide the deep learning to it. And so with the solar system, what we did is we created a kind of a working structure of the data for the machine learning. And what it was the US was the sun. It's not the same as the real solar system, because the real solar system, all of the energy comes from the sun. And so, no, we didn't say that. We just said, 50% of the energy, which is about, what it was, I think, when we did in 06, 50% of the energy comes from the sun. And, the system learns over time. But, and so, for every planet was a country. And then every planet had its exposures. And so with Chile, Chile has its stocks, its Campo Serviceria Unidas, but it also has, copper is a gigantic part of the Chilean planet. It's like 90% of their output. So, sorry. So like I said, we had to spoon feed the data. And so the deep learning could view, it could say, I like, Earth planet, I'd like UK planet. And then if you like the planet, go in which parts do you like the most. And so the idea being that, for instance, when we bought January of 2009, the system saw steel prices stabilizing, after a terrible economic crash. And it saw Brazilian industrial output growing. And, it liked TX Ternium for a lot of fundamental and balance sheet reasons. In fact, when we bought Ternium in 2009, it had, I think, a 600, 700 million market cap, 900 million of unrestricted cash, and like 500 million of cash flow. Talk about cheap. And so, it essentially was, it had its steel relation, it had its Brazil relation. And so the idea being that, we need the economic, and then within the economics, we have the industry. And so, well, it's, three-tiered: the planet, the country, then the economics, and then the industry. But, before we kind of started spoon feeding the data, we had tremendous failure with our deep learning. It was so important. You really need to narrow the window of decision making as much as possible. When I did my natural language processing project with Cornell last semester, we decided, what were the positive words, and then we used the machine learning to decide which of those positive words were more important. Like I said, machine learning is just an optimizer. Once you have your theory, machine learning can optimize your theory really well. And sometimes you can have a machine learning to optimize the theory, and then another machine learning to optimize the optimized, which is what we did. And so, it's just about taking your data, and so, our deep learning worked really well in 07. Economy was great and strong. And then by 2008, economy started, things started getting sour. And in fact, real estate went negative on our system as early as April and June of 2007. In April of 2007, real estate first dropped as a investable asset. And then by June of 2007, our deep learning had real estate as the lowest ranked US sub-industry. And so we started publishing, by the way, an economic report with all of our, currencies, commodities, everything that we had. And that's available. It's expensive, but it's available if everybody wants it. Nevertheless, in 2007, 2008, the economy moved slower. Everything is moving quicker now, which is another reason why we had to change up our system, something that we learned. So the 2008 financial crisis was a spectacular train crash, but it was a slow motion train crash, one that started, in the first half of 2007 in many respects, maybe even late 2006, and one that came to full fruition not until September of 2008. So you have a lot of, lag time there, just a ton. Whereas if you look at Corona this year, oh my God, we had a strong economy in February. And then by the end of February, Corona was hitting. By early March, we were going to be in a Great Depression. I was speaking to the brightest people around with their gigantic funds, and Great Depression, Great Depression, Great Depression. It was amazing. And then, 3 months later, we're flat. 6 months later, we're up huge amounts. 9 months later, we're in a whole new economy. We are in a whole new economy now. Corona sped up the inevitable job loss that we were going to have to do. Everybody got to fire everybody. And there's going to be a lot more firings, by the way, too. Just you wait. The whole returning to the office thing, and everyone's going to go back to the office. Why? Because you get a more efficient employee. Okay, and everybody wants an efficient employee. Jamie Dimon said it. It's obvious everywhere. And so the employees that don't want to come back to the office, they'll be the first ones fired. But then it'll spread to others. Companies can run more efficiently now. They've learned that. They don't need as much personnel. But at the same time, we're in this absolute entrepreneurial nirvana. There are so many niche services that can create significant revenue that it's never become easier to be an entrepreneur. The cost of being an entrepreneur has never been easier. Obviously, you want to pick and choose your state depending on, how much red tape. It's really important. I mean, personally, if I could live anywhere, do anything, and I had an idea for as an entrepreneur, I would move to Ukraine. The Ukraine has a 4% tax on your earnings, which is the lowest tax I've come across. They also have a ton of government money for new ideas. So if you're a citizen and you want to move to the Ukraine, you can apply for $100,000, $200,000 for your new company, and the acceptance rate's over 50%. So, obviously, who wants to live in Ukraine? It's not as much fun, but that's another point where some governments are more friendly towards new business, other governments are less friendly. New York is not a government-friendly business place. It's not. They're very arrogant and elitist about, we have a great place, so, come here and work. Whereas I know Florida, Rouse University of Miami is very, very, very business pro, and with their lower taxes, and taxes are very important. But anyway, and so we had this train wreck. Everything fell apart in 2008. And our deep learning did a great job, just absolutely killed it. And we killed it in our first 4 years, we did an average outperformance of like 1,300 basis points a year. So yeah, we were just on absolute return alpha fire. But then 2011 came around, tripped us up big time. We got distracted because we were in acquisition talks with Moody's, and we had signed a research partnership with them. And so for 18 months, we were working with Moody's, developing deep learning prediction software for their bond rating system. And Rebellion's deep learning was actually able to improve Moody's forecasting by up to 2.5% a year. But we could never really work out details. It was never really enough money. Michael Karsh actually offered Rebellion $13 million for like a 75% stake. But we really didn't want venture capital people. What we did end up doing was, I don't know if people know Oh God, what is the name of our venture capital firm? Oh God, the Pilot Group. I'm getting old, obviously, but the Pilot Group was a venture capital group that funded the Thrillist Company, Daily Candy, Huffington Post, and they bought a 6% stake in Rebellion, which was perfect for us. It was a 6% passive, no voting, no anything stake at a very high valuation, and so that was perfect for us. We didn't want people to bother us, and so when you get VC funding, it's great. You have this funding, but then you don't realize you're making a deal with the devil. One of my sister-in-laws is a Harvard Business School professor, but the other one founded Rent the Runaway, which is a well-known dress rental firm. And Jenny jokes that when she first sold her equity to Bain, she was all excited the first day, and then the second day it was like, oh my God, I just hired the most clingy, obsessive babysitter I could ever imagine. We're going to look through every little thing I do. So, you really got to judge when selling your venture capital. So, we took our little stake. It was good. We went to cash flow positive by 2009, I think. So, we were pretty smoking. And we just wanted a little extra capital to mess around with R&D. And then in 11, so what happened was in 2011, we got caught with the S&P debt downgrade. It was the first time S&P or Moody's, a major ratings agency, had downgraded the U.S. debt. And so we were caught. Our deep learning, and by the way, we had been suspect of deep learning prior to 2011. We developed a reinforcement or deep reinforcement learning system. So, and actually this gets us also, by the way, to nowcasting, which is something that I published research on, and I did a lot of research on. So I was lucky enough to, Macy's did a partnership with me where they gave me 50 of their leading revenue sources on an hourly basis. And I took these 50 Macy's revenue segments and I used nowcasting. Professor Marcos Lopez de Prada, colleague from Cornell, found that nowcasting had like a 99% beta with predicting the S&P sell-off in March, just for the corona. But the problem with nowcasting is it moves too quickly, and so deep learning moves too slowly. So that's why we had to make it a reinforced deep learning, which we learned in 2011. We had to speed that thing up. Okay, we had to be more superficial, more reactionary. Reinforcement learning is the act of trading a pawn for a rook. And so reinforced deep learning looks at these huge pieces of data, but is much more influenced by the more local data as opposed to the 20-year history of data. And so the last 2 years becomes 90% of the prediction, and the previous 18 years becomes 10% of the prediction at times, or even less depending on what the system thinks is best. And so, the system might ignore all of the historical data at times, depending on the RL. But with nowcasting in Macy's, it was really exciting. I was so excited, like, oh, this is so cool. I've never partnered with a major retailer before. Rebellion Research, I couldn't publicize the partnership until we had some positive findings, but we had very bad findings. What we found was that nowcasting was absolutely worthless. In fact, we had to mess around with that data so much. We had to create these like 2.5-week intervals based on sum, and it was just, oh God, it was such a, we really essentially had to make anything that worked, we had to totally, fit the data, and it was only just to conclude that research. But the problem with nowcasting is good at, looking at Times Square and saying 60% of everyone in Times Square, is wearing a mask. And over the last month, here's the graph of mask usage. That's what nowcasting is perfect for. It's nowcasting the representation of the data, but that's not the way the stock market works. So something that Societe Generale found, which is what also I found with Cornell last fall with NLP, is that it takes up to 90 days for positive and negative quarterly reports to have that information disseminated within the market price. So humans act slowly. And then with MiFID II, it's even slower in Europe. MiFID II said that in Europe, the hedge funds and mutual funds couldn't soft dollar. Soft dollar is when the brokerages give them free research. So essentially, most funds in Europe 2 years ago lost their free research. And so they don't know how every stock did in their quarter, and it takes them longer to respond. The average hedge fund analyst
has 50 stocks. The average mutual fund analyst has like 80 stocks. So how do you know if ABC satellite did well or CBD satellite did well? It takes you time to get there. And you're just the big hedge fund and the mutual fund and the investor. So it takes time for these prices to move. And nowcasting is too quick. Nowcasting, and that's also, by the way, why I don't like quantum computing. Quantum computing is like putting a 747 engine on a used VW. Why would you do that? You wouldn't do that. It doesn't make any sense. You would kill yourself. And so with quantum computing, you're just zooming ahead and you're trying to forward guess a bunch of creatures in a pen. That's all the stock market is. It's a bunch of human creatures moving from one side to the other side. So that's all you're doing. You're forward predicting, taste movement. So it's a much simpler task than people give it credit for. And reverting back to Renaissance technologies, most of their money is made from $5 to $10 stocks that fell below 10 and they're probably going to move to 5, or stocks that rose above 5 and will probably go back to 10. And I'm sure most people know that many mutual funds can't buy below 10 or they can't buy below 5. So those numbers have a huge amount of meaning. So Renaissance has made so much money, continues to make so much money just trading $10 and $5 stocks. And so there's a lot of simplistic trading out there. And that's why short-term high frequency is ideal for deep learning, because United Healthcare's 930 to 931, it's all very set. It's in a vacuum, and deep learning does great in a vacuum. And that deep learning starts to have trouble when the vacuum starts to move, and that's why you need reinforcement learning, because reinforcement learning can kind of move the deep learning. And so if you think about deep learning as good, suitable for a lake, and reinforcement learning is suitable for an ocean, or maybe the other way around, it's a nice way to come in between the two. But nowcasting is too quick for any markets. I'm sorry, my talk ends. We have the panel begins in like 5 minutes, and so I'm trying to get all this information in before my panel begins. So we have like 5 minutes left. Are there questions, by the way? People want to shoot any questions out there? Okay, so if there are no questions, I'll just continue then. So that's what happened in 2011. 2011, we were caught off guard, and our deep learning portfolio did not pivot quick enough for the economy. And what happened was we entered July of 11 seeing a very strong economy. And so we were very, very aggressive on the stock market. But our RL started seeing some signs of slippage. And so, and we were already running this reinforcement learning portfolio. So, we got a question. What is future of machine learning for the industry? Oh, that's a great question. It's all about natural language processing. I would recommend natural language processing be the skill set that everybody learn right now. Natural language processing is the ability to have computers interact with human communication. And so we're all manners of walks of life when it comes to NLP, what you can do. It's amazing. From rig orders to just all communication through proper NLP can be addressed. And NLP is getting better. NLP is still very stupid. It still has a long way to go. It's very tough. And so that's why, NVIDIA came out with this, NVIDIA's NLP platform is probably the best platform in the world right now. Their ability to process words is the best, and that's so 0.72. We're going to have Samir Gupta on. He'll talk about how 0.72 has really looked very hard at hiring NLP, but not just 0.72. I had AQR said Quant told me, we just want to hire NLP right now. And even McKinsey is working very hard to hire NLP guys right now, because think about the economic insight that McKinsey can have with better NLP. So much of the internet, so much data of the internet can be read and processed. And think about all the PDF documents that are out there that McKinsey could go and read. Permits for this, permits for that, which will show economic movement one way or economic movement the other way, or it'll show trends. Maybe, Wyoming had a surge in legal cannabis, research applications, but there's no way to know that unless you have an NLP system that can go on to Wyoming, the state of Wyoming government's page and read all of their documents and learn it. But then how do you find the documents? Exactly, it's hard. And there's going to be a lot of work to be done there. But that's the future of machine learning in investing, is all the smart natural language processing that can be done. I mean, think about all of the kind of esoteric code breaking that can be done of global movements through natural language processing. The communication that can be inferred, is absolutely fantastic. By the way, we still run our deep learning portfolio. It does very well, but it faltered again. The deep learning got caught up with the, we don't offer it to clients anymore. We just watch it. But watching it in 2020 was really fun. It got stuck with all the value, small cap value, so it got obliterated. And then, of course, later on, it just had its gigantic run up, and it barely moved past the Russell 2000, but it still actually had alpha last year. But it moved the way we expected it to. It takes deep learning longer to change its tune. And when our deep learning would come across a prediction, it would have many factors. And so our deep learning system would have between 150 and 200 positive factors for a alpha prediction. But our reinforced deep learning, our RL version, has an average 30 to 40 factors. So many fewer factors. It's much more versatile, much more dynamic. The ability to move quick is everything in finance, like I said. So it's a very fast-paced world, and I don't think it's going to slow down anytime soon. Like I don't think it's going to slow down. NLP intelligent bots are probably the future. So creating these bots that can go on and read things and create new data sets and learn and say, look at this, and then create, a chart based on that. Find corollary words in this data, find, 35 PDFs with corollary words, and then create this data set out of nowhere. That's the future. These intelligent bots that can read human documents and then create data sets not that we didn't know existed, but we couldn't have access to. Maybe at times, maybe we didn't know they existed. Most of the time, there will be these data sets that we just didn't have access to, or it may not have occurred to us that they were there. But anyway, this was a lot of fun. I'm going to conclude my my talk now, and we're going to get ready for the panel in about 90 seconds. So thank you so much, everybody. And, Paul, Professor Borsham, thank you so much for inviting me. It was an absolute honor to be here today.
Thank you so much, Alex. This was a wonderful talk with so much sort of the rare institutional detail that somebody who isn't intimately involved with AI and asset management would totally miss. In the couple minutes that we have remaining, I was actually hoping to ask you a question. If somebody sort of wanted to start on this sort of path, where would you recommend they go? Like, should they take a master's in quantitative finance? Should they, go back even earlier and study math as an undergrad? Should they do some sort of review and training on their own? What do you think
that's a great question,
would sort of
Paul.
be the path to it?
Okay, the number one thing anyone should do, and I've done it myself, and it's free, which is fantastic. What in this world is free? Nothing in this world is free. Everything costs money. Is Professor Naga, nice guy, very humble guy. His Introduction to Machine Learning 1, Introduction to Machine Learning 2 classes on Coursera are the two best ML introductory classes I've come across, short of like a tutoring session from some brilliant Caltech. You know, and I have one of those. I have this best friend who's the number one, you know, in his class from Caltech, super mathematician, psycho brain, and he's just like I guess all of my best friends are kind of psycho brilliant. That's one of the things I've been very keen about. You know, my best friends are all people who teach me that I can learn from, and you know, that challenge me as well. You know, I think it's important to have friends that challenge you. You know, everybody can tell you your clothing looks nice. It's the person who tells you that it's ugly clothing, the persons you need to listen to. So yeah, so I would definitely, engine that goes 1 and 2, you're good to go there. Yeah, go get a master's degree if you want, but you'll learn a lot from that. And Python, learn our program in Python, take his classes, start going. But anyway, are Douglas and Samir and Pangan, should we get going?